everyone, and welcome to our yet another discussion on financial reporting. In this particular lecture number 1, we are going to look at the borrowing costs, and this will open our discussion on borrowing costs. So, of course, in this lecture, we are going to first of all give the key definition of borrowing costs. We want to understand what borrowing costs are all about. Then we shall give some examples of borrowing costs. We shall look at the accounting treatment of borrowing costs, and then of course shall understand qualifying assets, and then we shall move into borrowing costs eligible for capitalization, how to determine those borrowing costs that are eligible for capitalization, and then finally we shall have a review of the exam type question that we shall handle in the following lecture. Straight away into our discussion, of course, we are saying you can still access a variety of these lectures on our site www.harvestuganda.com, or just by sending us a WhatsApp on those numbers. So we continue to upload lectures every week. Going straight into our lecture, of course, we begin with a key definition. We want to understand what are borrowing costs. So in the bullet we are saying borrowing costs refer to interest and other costs incurred by an entity in connection with the borrowing of funds. But the standard gives us some of the examples that we can make of in regard to borrowing costs. And in this slide, we are saying International Accounting Standard 23 lists what may be included in your borrowing costs. First on the list, we have interest on bank overdrafts, short-term and long-term borrowings. That interest that you incur on short-term, be it long-term borrowings or bank overdrafts for that matter, is part or an example of what you're talking about here, the borrowing costs. Second on the list are the finance charges in respect to the leases recognized in accordance with our new standard IFRS 16. The finance charges shall also fall in this category of borrowing costs. And then number 3, any exchange differences arising from the foreign currency borrowings to the extent that they are regarded as an adjustment to the interest costs are going to form part of the borrowing costs that the entity is going to incur. Alright, so after understanding clearly the examples of borrowing costs and what borrowing costs mean here, we move into the accounting treatment of borrowing costs. What does IAS 23 have for us in store? So in the slide we are saying all eligible borrowing costs must be capitalized. Okay, IAS 23 requires that only those eligible borrowing costs should be capitalized as the cost of that asset. So of course we need to understand what is the meaning of eligible borrowing costs so that we do not give a wrong treatment for those borrowing costs that will be incurred. So in the second bullet, the standard is saying that only those borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset can be capitalized as part of the cost of that particular asset. In this bullet, the standard is listing some of those ways, different ways in which an asset may be acquired. Okay, the entity may acquire an asset through acquisition, that is ideally purchase, construction, or production. In the case of inventories, can go through the process of production to just acquire an asset. So all of those borrowing costs that are directly attributable to those 3 processes mentioned here, we are saying are going to be eligible, okay, are going to be eligible for capitalization. However, the standard is very, very keen here, mentions something to do with qualifying assets. So if the acquisition, construction, or production is in regard to a qualifying asset, then capitalization may be permitted. However, of course, the standard gives us, in the third bullet, the standard gives us the criteria for determining which borrowing costs are going to be eligible for capitalization. Now, before we go into this criteria, we first of all need to understand what is a qualifying asset for that matter, because the capitalization is only going to be made for those qualifying assets. So the question is, what is a qualifying asset? Our next slide moves into the discussion of what a qualifying asset is all about. So in this slide, we are asking ourselves, what is a qualifying asset? And of course, the answer is that the qualifying asset is that asset that necessarily takes a substantial period of time to get ready for its C, intended use or sale. A qualifying asset, here we are saying, is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Now, of course, the standard gives us some of the examples that we can take as a qualifying asset. So in the second part, we are saying that depending on the circumstances, any of the following may be qualifying assets. One, we have inventories, and then number two, we have manufacturing plants. Number three, we have power generation facilities. Number four, we have intangible assets, and then last on the list are the investment properties. So all of these, according to International Accounting Standard 23, they fall in that class of a qualifying asset, because there's a belief that these are really going to take a substantial period of time to get ready for their intended use or sale. Now, there is a big contention here on what would be a substantial period of time. Okay, what would be a substantial period of time? What I need to mention here is that International Accounting Standard 23 does not really pronounce itself on what would be the substantial period of time. So we cannot tell whether it is a month, whether it is a year, whether it is 5 years. So professional judgment will have to be used when you are determining what is substantial. Now, in the following slide, there are points to note. We need to note two major things. One, those financial assets and inventories that are manufactured or otherwise produced over a very short period of time are not going to fall in this category of qualifying assets, and therefore they are not qualifying assets. For example, if you talk about juice is an inventory. If your farm deals in the sale, manufacture of juice, really juice takes a very short period of time. If just 5 hours will be enough for you to prepare and put them on shelf. So in that case, those inventories may not really be qualifying assets, and any funds that you have borrowed to manufacture those inventories would not ideally be capitalized. It is not permissible to capitalize those borrowing costs. Then note number two, we are saying that assets that are ready for their intended use or sale when purchased are non-qualifying assets. Definitely, if you borrow funds and you simply purchase an asset, the asset is already on the shelf and you simply purchase it, definitely the borrowing costs that you're going to incur on the purchase of that asset, they're not going to be capitalized as part of the cost of the asset. So assets that are ready for their intended use or sale when purchased are not qualifying assets. Okay. Of course, those are two things that you need to note. Definitely, the gist of our discussion today is just to understand how we determine eligible borrowing costs so that we can do the accounting correctly. So in the next slide, we move into those borrowing costs. How do we determine borrowing costs that are eligible for capitalization? So in the slide, we are saying those borrowing costs, okay, those borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset must first of all be identified. You must identify, is it interest? Is it a finance charge? Or is it an exchange gain, as we have given in our examples of borrowing costs? So IAS 23 is saying that those are the borrowing costs that would have been avoided had the expenditure on the qualifying asset not been made. So the borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset, we believe, are those borrowing costs that we would ideally avoid had the expenditure or had the decision to acquire, construct, or produce a qualifying asset not been taken. So those would be the borrowing costs that you would ideally avoid had the expenditure of the qualifying asset not been made. So we continue by saying that this is obviously straightforward where funds have been borrowed for financing of one particular asset. So we are saying that it is easy for you to identify borrowing costs that are eligible for capitalization if the firm has straight away gone to the bank, borrowed money to particularly or specifically acquire, construct, or produce a qualifying asset. There it would be very, very easy for you to identify those borrowing costs. However, we are saying difficulties arise where the entity uses a range of debt instruments to finance a wide range of assets, so that there is no direct relationship between particular borrowings and a specific asset. For example, all borrowings may be made centrally and then led to different parts of the group or entity. Judgment is therefore required, particularly where further complications can arise. So we continue by saying that once you have identified all those relevant borrowing costs which relate to a specific asset, Then the amount of the borrowing costs available for capitalization will be determined as follows. So first of all, you're going to get the actual borrowing costs that have been incurred on those borrowings during that period. Get the figure, put it right there. Then you will deduct any investment income on temporary investment of those borrowings. Okay, so the investment income is going to be deducted from the actual borrowings, and then the figure that you are going to get are the borrowing costs that are eligible for capitalization. That is the figure down there. Now, the issue of investment income, it has been proven beyond reasonable doubt that entities actually invest part of these borrowed funds to earn investment income. So we are highlighting on the following slide that it would not be unusual. It would not be unusual for some or all the funds to be invested before they are actually used on a qualifying asset. Anyway, it is also a fact that the construction, production, or acquisition of a qualifying asset will take substantially a very long period of time. So it would not really benefit the firm if these funds simply lie idle on the account. So it would be a very, very wise decision to first of all invest these funds as they are way to be expended on the production, acquisition, or construction of a qualifying asset. Now we are going to support, of course, our this particular discussion with an activity question. I'll just run through it, then I leave you to read through and understand the issues raised here. Now, they are saying that on 1st of January 2019, the company borrowed 1.5 billion to finance the production of two assets, both of which were expected to take a year to build. Work started during 2019. The loan facility was drawn down and incurred on 1st of January 2019 and was utilized with the remaining funds invested temporarily. So the breakdown of the expenditure, the assets are A and B, and on 1st of January 2019, 250 million were incurred on asset A, and then 500 million incurred on asset B. Then later on 1st of July, you can imagine after 6 months, on 1st of July 2019, they went back, picked 250, spent it on asset A, and picked the balance of 500 million and spent it on asset B. Now, where was this 750 million? You see the 750 million that was ideally not utilized in 6 months? So my thinking is that this money, the 750 million, was actually lying on an investment account and earning investment income. So we are told that the loan that was obtained by the company was at a rate of 9% interest. However, the idle funds can be invested at a rate of 7%. So we are required definitely to calculate the borrowing costs, which may be capitalized for each of the assets, and consequently the cost of each asset as at 31st of December 2019. We are told to ignore compound interest because that would ideally further complicate our accounting here. So go straight to our next lecture and pick up the solution to this activity so that we can further appreciate the accounting of borrowing costs in compliance with International Accounting Standard 23.